Homeowners, did you know that there's a different way to pull equity from your property?
Hi, my name is Joseph Falla, and I'm a licensed loan officer with the Got Mortgages team, powered by Paramount Residential Mortgage Group.
If you've been searching online about pulling equity from your home, you're going to see a lot of different ads. Everyone is trying to grab your attention, telling you how to tap into all this equity you've built over the last 5 years. But most of these ads don't explain the difference between each option. So let me break it down simple for you. There are 3 main ways homeowners can pull equity out of their property: a HELOC, a home equity loan, or a cash out refinance. They all do the same thing, give you access to the equity in your home, but they work a little bit differently. Option 1, a HELOC. A HELOC stands for a home equity line of credit. Think of it like a credit card secured by your house. You're approved for a limit, let's say $100,000. You can borrow $10,000, pay it back, borrow again. The downside, the interest rate is usually variable and the balance can continue to change over time. That's why most HELOCs are offered by banks and credit unions, not your typical institutional mortgage bank lenders. The second option is a home equity loan. Instead of a revolving credit line, you're receiving a fixed amount of money up front. At PRMG, we offer a hybrid HELOC option that I famously coined the 555. That means a 5-minute application, 5-minute approval decision, 5-day funding. The biggest advantage, you don't touch your current mortgage rate. The value of the property is often determined using a desktop appraisal, meaning the process can move a lot faster. In many cases, there's no traditional appraisal. You skip the title company, and much of the paperwork can be completed right from your computer. So if you've locked in a great mortgage rate a few years ago, you get to keep it. You're simply adding a second loan on top of your equity. The third option is a cash out refinance. This means you're replacing your entire mortgage with a new one. Let's say your current mortgage is $300,000, but your home is worth $500,000. You might want to refinance it to, let's say, $400,000 and receive $100,000 cash back. But the key thing to remember, you're also replacing your current mortgage interest rate. And in most cases, this option will require full documentation, income verification, and a traditional appraisal similar to the one you got when you first purchased a home. This is where homeowners sometimes make a mistake. They hear, access your equity, and immediately jump to a cash out refinance. But if you currently have a 3 or 4% mortgage rate, replacing that loan might cost you more than it's worth. Sometimes the smarter move is leaving your first mortgage alone and using a home equity loan instead. And I always recommend speaking with a financial advisor before making any major money decisions. Every homeowner's situation is different. Some people need flexibility, others need speed. Others might need a larger amount of cash. If you're curious about how much equity you could access, send me a message and we can schedule a quick call. And as always, don't let the fear of the unknown stop you from making a smart decision with your home equity.